Hello and welcome to the AGM presentation for Henderson Far East Income Limited. I am Mike Kerley, and along with Sat Dura, I am one of the portfolio managers for this company. Now, usually we would be doing this alongside an AGM where we'd have an audience and the opportunity for questions, etc., and then have a cup of tea afterwards to discuss everything. Sadly, in this environment, we can't, so we have to do it all virtually. But fingers crossed, hopefully this time next year, we might go back to the original arrangement, which is much more satisfying, I'm sure, for all of us. So without further ado, what I'm going to talk about today is I'm going to talk about a few highlights of the year. Obviously, this is the AGM presentation, so it's based on the year end of August 2020. So I'll give you a little update from that, but also where we are now, because August was a few months ago, and as you're well aware, markets and economies and events are changing very quickly around us. And then I'll talk a bit about performance. It wasn't a great year for us in terms of capital, but it was a good time for us in terms of income. So I'll give you some details about that and what we expect going forward. Obviously, we can talk about COVID, the impact on Asia and the impact on the rest of the world. And I will show you a few charts as to why actually Asia seems better positioned than most, both in terms of where we are now and obviously what happened through most of 2020. And finally, just talk a little bit about the portfolio, what we're investing in, what our exposures are, and some of the companies that we've been adding to recently. So, straight up, highlights from last year and obviously a few updates for where we are now. So as I said earlier, the first point there, it wasn't a great year for us in terms of total return. The NAV actually fell 3.4% over the 12 months to December. And usually when I stand up in front of you at the AGM, I've mostly had the pleasure of telling you about positive returns, but on this occasion, this is negative. And there are some reasons for that, and I'll talk to you a bit more about that in the coming slides. The income performance, however, was much better. Total income rose by 9.5% for the full year, which, when you consider that a lot of income generating funds actually dipped into reserves last year, we didn't. We actually added to our reserves and we covered the dividend. So the performance of the companies in income terms was very good and very pleasing. Sadly, that didn't relate necessarily to capital, but as I say, I'll talk more about that in the coming slides. We increased the dividend, or the board increased the dividend by 1.8% back in June, and that at the time certainly was ahead of UK inflation, and carries on our record of continuing increasing the dividend since 2007. The dividend yield was 7.2% at the end of December. It's been a pretty strong start to the year, so the dividend yield now is about 6.8%, mainly because the price has risen, which is the right way for yields to go when prices rise rather than just being cut. And the revenue reserve was pretty stable at just over 50% of a full year distribution. We're also pleased to announce the continued premium rating that the shares attract. So we've been able to issue more shares, about 1.8 million shares from the end of the financial year to the 14th of January. The shares still trade at a premium, and there is demand, and we will continue to meet that demand in order to keep that premium at a reasonable level. So when we look at the year in terms of revenue, the revenue from the portfolio grew by 6.9% for the year. Option premium was a lot higher. Option premium rose by almost 50%, and that doesn't reflect the fact that we had or wrote any more options last year. It's just the fact that markets were more volatile. So when we wrote options, we got paid more for them. As a result, option premium had a greater contribution to the company's revenue this year than it has done in previous years. So almost 11% of the total income the portfolio generated. And we've said that in previous years, that actually when we get more volatile times or weaker times, when companies aren't really committing to dividend payouts, and 2020 was certainly one of those, that actually we get a higher contribution from option premium in that environment. And that was certainly the case this year. But overall, a very strong and progressive revenue stream, as you can see from this chart. As I mentioned, the shares have traded at a premium virtually all year. There was a slight dip at the beginning of this year when we went into a discount when COVID reared its head in Asia in the first quarter. And again, slightly towards the end of the third quarter. But more recently, we've gone back to a premium and continue to issue shares. The number of shares we issue has been growing, as you can see through the chart at the bottom. And FY20 was the largest amount of share issuance we've had in the company's history. And obviously we started FY21 slightly slower, as we're nearly halfway through the year, and clearly it may be a struggle in this environment to issue the same number of shares as we did last year. But the board and I feel that as long as there's demand for the shares, we'll continue to issue, and it's always enhancing for existing shareholders because we do it at a premium to NAV. So performance. And we get asked a lot of questions about why our performance has lagged this year or last year over the last 12 months. These numbers are up to the end of December. And the chart on the right-hand side breaks down the performance into three parts. Henderson Far East Income is the dark blue line. The red line is the FTSE All World Asia Pacific ex-Japan Index, which we use for comparison purposes, alongside the MSCI All Country Asia Pac High Dividend Yield Index, which we also use for comparison purposes. And until really the middle or the end of the first quarter of this year, those three lines were running pretty much in parallel. But really from the onset really of COVID in the West, which happened in the second quarter, there's really a marked difference. So we saw the index massively outperform both the Henderson Far East Income and the High Yield Index. And I'll talk about that in the next few slides. So on a discrete basis, as you can see, mostly I've had the pleasure of telling you about positive returns, but unfortunately this year we don't. And the reasons for that really are this massive differential between growth, value, and yield. And a lot of people focus on the fact that value has underperformed growth so much in the last 12 to 18 months, but actually dividend yield has underperformed value. So you've got this massive differential, again, really focusing on these five different lines here. So the orange line is the growth component of the MSCI All Country Asia Pacific ex-Japan Index. The blue line, the light blue line, is the index itself. The red line is the value component of that same index. The blue line is the high dividend yield index, and the green line at the bottom there is Henderson Far East Income. So value's underperformed growth by a considerable margin. It's underperformed the broad index by a considerable margin, but yield has actually been worse than value. And I suppose us having the largest yield in the index, and as I say, 6.8%, it was over 7% for most of last year. When we have a highest level of yield, clearly it's not a big surprise to see us underperform other strategies with lower yields, considering how bad a performance yield was. I'll talk a little bit later on about what our expectations are. But broadly, I think yield has underperformed for too long. And the bottom line here is that this is still a low interest rate environment. The world is getting older and the need for yield is really acute. And we will see more focus towards yielding shares as we go through this year. And the reason why I'm more optimistic is that I've never seen, in the 25 years I've been managing money in Asia Pacific, I've never seen this scale of divergence in terms of performance. This chart I'm showing you now just looks at the top 25% yielding stocks by region and what their valuation is to the broad market. So you've got the orange line, which is Asia ex Japan, red is US, black is Europe, and the blue is Japan. And basically what we've seen really over the last 1 to 2 years is yield being completely out of favor. So that discount that those shares trade at compared to the broad index in most regions got to 30 and 40, 50% almost. In Asia now we're at 55% discount to that broad index, which, considering, as I say, we have low interest rate environments and dividend yields, the premiums that dividend yields trade over bond yields and cash, which is in Asia's case about 3.5 to 4% and never been wider, that I'm surprised, to say the least, that we haven't seen better performance out of yield with that backdrop. I think this chart is interesting, not only because it shows the massive potential capital upside from income, because it's so undervalued, but I think we can also look back at the recovery post the global financial crisis, which I think is something which is relevant in today's terms. Because back in 2008 and 2009, we had a big sell-off, we had a big recovery, and then it's what happened after that, which I think is important. So in 2010, 11, 12, all the way through to 2014, really, there was this need for yield. I don't know if you recall it, but basically stocks were being bought for yield, almost irrespective of valuation. In the same way that people are buying electric vehicles or Tesla, almost irrespective of valuation. The same thing happened with yield back through that period. And that was a period which was accompanied by record low interest rates, not necessarily government support, but more central bank support with quantitative easing and aggressively cutting interest rates. So that push for yield actually made those top 25% highest yielding stocks in Asia actually at a premium to the market in terms of PE. So the valuations went from 20, 30% discounts or more actually to premiums through that need for yield post the GFC. Now, I don't think this is too dissimilar where we are now. As we've had the sell-off, we've had the bounce back. We're now in a period where we are being supported by liquidity, massive liquidity, both from central banks and from additional fiscal expenditure from governments, which is creating a boom in certain stocks and sectors. But when we come out of that and we normalize, what we're going to be left with is probably similar to what we were left with post-GFC, which is a period of anemic economic growth globally, accompanied by probably still record low interest rates and a degree of government support. And that's the ingredients whereby yield outperforms. So I can't tell you when that's going to happen, but my basic view is that at some point over the next 12 to 18, 24 months, we'll get that period post-COVID where we have benign economic growth, low interest rates, and government support, which should see yield outperform in the way it did post the GFC. And coming from the fact that we're at 50%, over 50% discount to where we would normally trade from these yielding shares, this could be quite a significant capital event as well as an income event. To give you some of the idea of the frustrations, and this is, I suppose, a little bit of a rant on my part, but this is an example of 3 stocks we own in the portfolio and 1 we don't. And what this is trying to show is the fact that actually fundamentals in this point are kind of getting thrown out the window in favor of themes and long-term strategic ideas. By those, I mean things like the internet, e-commerce, anything to do with electric vehicles or alternative energy. These sectors, interesting though they are getting bid up to the point where the valuations are almost looking like tech did in 2000. And a lot of real economy, good companies are kind of getting avoided and ignored in this environment. So 3 companies we own here, which are part of our China portfolio, are Hungan International, CITIC Securities, and China Resources Cement. And these charts just show you the share prices in red against the analysts' earnings revisions. So what analysts expect earnings to be on a 1-year forward basis. So just taking Hungan, which makes tissues and sanitary wear and nappies and diapers, the analysts keep upgrading the earnings, but the market doesn't care. That stock has had a massive derating from a PE, i.e. the E's gone up and the P's gone down, so the PE looks cheaper. The same with China Resources Cement. Again, cement prices have been pretty strong in China because of a lack of supply more than demand. But as you can see, earnings go up, prices go down. So these are stocks that are trading on 4-5 times PE with 6 or 7% dividend yields, despite the fact they're good companies. CITIC Securities is often nicknamed as the Goldman Sachs of China. It's a brokerage, but does a bit more than that as well. And although earnings have come lower, if you look at the scales, so the share price has come down from $19 to it went to 14 at one point. It's quite a considerable fall, 20-25%. Earnings have only come down by from 133 to 127. So less single-digit decline in earnings. So again, a derating. And you compare it with one of the hot themes or the hot strategies, which is electric vehicles. And Geely is one of the largest local brand manufacturers in China. Yes, it's launching EVs. Yes, it's got to tie up with some internet companies, etc., to develop autonomous vehicles and electric vehicles, etc., etc. But to be honest, how much money they make from this is still out to debate. And the market isn't that optimistic in the short term because you can see the earnings haven't really moved at all, but the share price has more than doubled. And you can extrapolate that for a lot of the auto sector. I mean, Tesla is the poster child of excess when it comes to people's euphoric responses to what Tesla could become and what it is at the moment. So we have suffered in the portfolio for having companies which are not at the forefront of people's views on what is going to perform short term. Although we're quite happy with the performance of the companies we own, it just hasn't been reflected in share prices yet. And I underline yet. So that's some of the frustrations we've had in terms of performance. We've owned some good companies which haven't performed as we'd have hoped, although their underlying performance has been pretty decent. We haven't had in the portfolio clearly some of the internet and the e-commerce names which are very expensive and don't yield. We've had maybe too many high-yielding stocks, but considering that our mandate is for a high yield and when we pay a dividend as high as we do, it's not a big surprise that we have telcos and property REITs, etc., in the portfolio, which make up the backbone of our income generation. And again, these have been somewhat ignored in the current markets. So moving on a little bit to COVID, and I'm not going to talk too much about this because we're probably sick and tired of seeing graphs about COVID infections, etc. But the point I want to make is that actually, although the virus originated in Asia, in China specifically, that actually Asia hasn't been that impacted by new infections. And that could be down to a lot of reasons. Maybe it's a degree of underreporting. Probably it is in some of the more populous and more developing economies, Indonesia, India, etc. But on the whole, I think it's probably down to some pretty astute policy making. Especially in China, they clamped down. Taiwan, Korea, the same. Even in Australia and New Zealand, we've seen, the economies the actions taken by governments to curtail people's activity and curtail the infection rate has been generally very successful. There has been a few exceptions: India, Indonesia, and the Philippines, which on the next slide, you can look at the individual rates by country. What's interesting about this chart is actually the orange line in the middle there, which is India, is the only country on this list which is on the right-hand scale. And if you look at the number of cases on the right compared to the number on the left, there's quite a significant difference. In fact, over the last 6 to 8 months, 80% of the cases in Asia ex-Japan were in India. Although those cases have come up quite dramatically now to around 20,000 a day from almost 100,000. The one that's a little bit worrying here is Indonesia, where we continue to see elevated or increasing number of cases. But then again, you look to the left-hand side, and what that means is 10,000 cases a day. And you compare that to the UK, which is seeing 40 to 50,000 cases a day. Indonesia has 250 million people, and we have 65. So yes, it's a worrying trend, and we'd like to see that turn around. But as yet, the scale is nowhere near what we've seen in the West. And I think this is down to a few things. I think generally in Asia, we're talking about younger populations than we see in the West. So generally more resilience to infection. We also have temperature. A lot of these countries are tropical. So temperatures anywhere, 28 to 35 degrees all year, and that probably helps. But most importantly, I think government action has been prompt, strict, and more importantly, the people have generally adhered to it. And I think there's a slight difference there. Asian people are used to wearing masks. Asian people are used to reacting to virus. We've seen SARS and various other viruses sweep Asia in the last 20, 30 years. So they're more nervous about the potential. They're much more likely to adhere to government policy and much more likely to adhere to restrictions, especially regarding face masks and social interaction. So what does all that mean for GDP growth, earnings growth, and dividend growth? Well, these are the charts for, again, those economies. So Asia in dark blue, US in red, Europe in orange, and the UK in light blue. And we start on the right-hand side with GDP growth. Obviously, there's some massive declines, especially in the UK, but obviously Europe as well, and the US doesn't look great. Followed by forecast to be decent recoveries. So basically, the UK is going to have a pretty awful 2020, but is forecast to have a pretty decent bounce back. I am a little skeptical about that, considering how we started 2021, and actually the second wave could last well into the middle of the year. So I think you have to call into question what the recovery would be like in the UK in 2021. Again, I think you also have to call into question some of the recoveries in Europe and the US, because the impact of COVID, as I say, is going to last for quite a while. Now, Asia only forecast to have about a 1% decline in GDP growth in 2020. So a mere blip, if you like, in the growth trajectory, and forecast to have a 6% GDP growth recovery in 2021. Whether that number is the right number, I don't know, but I would suspect that the growth trajectory of Asia is much more secure for this year than it is for the US, UK, or Europe. And earnings growth, again, in Asia, this year we're expected to have flat earnings growth. So although we've had the worst recession in pretty much 100 years in the West, and earnings growth in Asia was flat. And we'd like to see a significant recovery again, something in the region of 25% in 2021. Again, I think you have to call into question some of the numbers elsewhere, because you're seeing big declines and big rises. And depending on how long COVID lasts, then those earnings numbers for 2021 could prove to be a little optimistic. And the same is true as dividends. As I mentioned earlier, the dividend portfolio performed incredibly well from an income perspective. So dividends for the whole region only declined 5%. And we expect probably mid-teen growth in 2021. Consensus thinks somewhat similar. And I'm pretty convinced that Asian companies will be able to deliver that. Because if we're going to see earnings growth of 25% this year, and dividend growth of say 15, I think that's more than achievable, considering the payout ratio is already quite low, and there is a chance that some dividends which were cancelled will get reinstated, and there's a chance that companies that did do well in 2020 actually increase dividends rather than keep them the same. So when you see it in graph form, it all looks a big bar chart down followed by a big bar up. I think sometimes we lose perspective of where we end up. So what I've done is I've put these in terms of nominal numbers. And I think this makes it pretty clear. So Asia's the dark blue line. Again, the USA is red, Europe orange, and the UK blue. And this is GDP on the left-hand side. So basically, Asian GDP in 2021 will be considerably higher than it was in 2019. So although COVID was a big event, a very big event, from an Asian perspective, it's much less significant than the global financial crisis was back 10 years or so ago. The other regions, it's less clear. I mean, how long will it take for the UK to get back to the same level of economic activity as it was pre-COVID? That might be certainly not 2021, probably not 2022, it may be 2023. And Europe the same, probably not getting back to the levels they were pre-COVID until 2023, which gives you some idea of the wealth destruction and the economic destruction that COVID has had on these Western economies. Earnings-wise, again, I think these numbers may be a little optimistic considering what I've said to you about economic growth. Are we going to see earnings back in the US to where they were pre-crisis this year? That's what analysts are forecasting, despite the fact that GDP growth is some way below. And the UK and Europe expected to see earnings back to where they were pre-COVID next year, which is some way before the economy gets back to where it was. I mean, that may well be true, but I think you have to question some of those assumptions. Asia, on the other hand, it's, as I say, 2020 was a mere blip in the growth trajectory. And actually 2020 wasn't that much worse than 2019. And 2019 earnings growth in Asia was less than 5%. But if we get that big kick in 2022 and 2021, then earnings are going to be some way above where they were pre-COVID. So let's talk a little bit about valuations. And the markets have all started the year incredibly strongly after a pretty good year last year. And valuations, I think, are probably the biggest worry for equity investors everywhere. And that's true about Asia as well. The left-hand chart looks at the Asia Pacific ex-Japan PE ratio looking 1 year forward. And at 17 times or pretty close to 17 times forward earnings, these are valuations which are pretty close to where we were at the peak in 2007. So that would give you cause for concern. The only positive I would say from this is that actually, on a relative basis, Asia doesn't look that expensive, mainly because although prices have gone up in Asia, so have earnings. And actually the valuations in other markets look even more perilous, mainly because prices have gone up, earnings have gone down, so the market's just got more expensive. So on the chart on the right-hand side, you look at where Asia trades compared to other markets around the world, and actually it's still below its long-term average. So on a relative basis, Asia looks pretty attractive. Going back to that PE, 17 times, again, that's pretty distorted by the sectors I told you, which have outperformed considerably this year. So internet, e-commerce, give you some idea, Tencent and Alibaba are now 11% of this index. And these companies trade at 30 times earnings plus. So it's not a big surprise to see the average PE of the market go up so much when it's being dominated by stocks which are pretty expensive. Outside of that, there's quite a lot of opportunity. And I'll show you later that actually the portfolio for Henderson Far East Income has a valuation which is around about 12 times, so less than the long-term average. So yes, there's if you look at these charts, Asia looks expensive, but when you go underneath the cover, there is a lot of opportunity for value-based investors and income-based investors, for that matter, who can still buy attractive stocks at discounts to the long-term averages. This is a chart I put together just, and this is not a prediction about what happens this year, but I think it puts it into context of when Asia outperforms the rest of the world. And that tends to be when earnings is superior or is high, so growth is prevalent. So when earnings growth in Asia is higher than it is in the rest of the world. So if we look at 2009 is a prime example. So the diamond on here, the orange diamond, is the level of outperformance. So in 2009, Asia outperformed by pretty much 40%. And that's because the blue column, which is earnings growth in Asia, was up and earnings growth in the rest of the world was down. So Asia growth was superior, so Asia outperformed. That's the same in 2017, it was the same in 2007. And the reverse is true when Asian earnings disappoint. So 2015, Asian earnings growth was less than the rest of the world, so Asia underperforms. Now, the other time where Asia tends to outperform is when growth overall is high. So 2010, Asia marginally outperformed, even though earnings per share growth in Asia was slightly lower than it was in the rest of the world. And that's because when generally people want growth, they buy the regions that tend to have the most growth or associated with the most growth. So in 2010, Asia benefited from the fact that people were focusing on growth and to a certain degree of cyclicality. And where are we in 2021? Well, earnings per share growth again is forecast to be pretty high. Obviously, we don't know whether Asia outperforms or not, which is why the diamond's set at 0. Okay, at the moment, Asia's expected to have slightly less growth than the rest of the world, but at 20-25%, these are high numbers. So everything is in place, looking at the history for the last 13 years, to suggest that Asia does well in a growth-focused market relative to the rest of the world. So what about dividends? Well, I mentioned earlier there's a degree of resilience, and I showed you this chart before, which just basically looks at the health, if you like, of the corporate sector, and nothing's changed. So as we see in this chart, that basically companies are accumulating cash. They're not spending on ridiculous projects on the top right-hand side. So capital expenditures is modest. So companies are generating excess levels of cash. They don't have huge amounts of debt. We've seen a lot of US corporates in particular see debt levels rise as they borrow stock to buy back shares. That didn't happen last year, but it's been happening quite a lot in the past. That hasn't happened in Asia. So the ingredients are there for dividends to increase, and especially when payout ratios are lower than they are in the rest of the world. And actually, Asian dividends are more resilient than you think. So this is a breakdown of how many companies increased dividends, how many cut dividends, and how many kept dividends the same. So in 2020, basically 40% companies cut dividends. Sorry, 40% of companies increased dividends and 31% cut dividends, which is a lot better performance than it was post the GFC, when 45% of companies in Asia Pacific cut dividends. And that's a reflective, again, I think, of the fact that actually the impact from COVID has not been that dramatic for both Asian economies or Asian corporates. But even in these worst of times for us as income investors, and if I go back to 2008, that was the worst of time for income in Asia, you could still find 32% of the companies in Asia which were raising dividends. So there's a lot of diversity in what we have the chances to invest in. And obviously we're trying to avoid the companies where there's a risk of a dividend cut. So hopefully that gives you some comfort that there's a lot of stuff written about how volatile dividends are in Asia. The culture is not really there compared to other countries. But actually, if you're investing alongside cash flow and alongside management, that there's still opportunity even in the worst of times, and that dividends are actually more sustainable than people give them credit for. So talking about diversity of income, I just thought I'd show you where we actually get the income from in Henderson Far East Income. These are obviously at the end of August and they're in the report and accounts. But 36% of our income this year came from China. And there's a good reason for that. The dividends in China this year, they only generally pay once a year, and they're based on the year previous profitability. So dividends paid to us in 2020 were based on financial year 19, so obviously before COVID. So we saw decent dividend growth out of the China portfolio. Conversely, Australia was paying dividends semi-annually, and we saw the dividends get cut, especially in the banking sector, which we don't own, and we avoided. But the level of dividends coming out of Australia this year was lower than we've seen in the past. Also, we will have historically received some special dividends from the mining sector. We didn't see those in 2020, which is why Australia was lower. So the stocks we own in the portfolio, the top two, almost 10% of the portfolio, Samsung Electronics and Taiwan Semiconductor. These stocks have both performed incredibly well this year. They're nothing unique to us. I would expect every income portfolio and growth portfolio, for that matter, will probably own these two companies. We have been reducing Taiwan Semiconductor. The value has really started getting a little excessive in our view. And the dividend yield, which was 4% a year ago, is now 2%, which gives you some idea how the stock's done. Or how the dividend's gone up a bit, but not nearly as much as the share price. So having such a large position in a stock that yields 2%, considering the portfolio distributes almost 7%, is very difficult for us. So we've been taking profits on Taiwan Semi. We like materials. We think of all the value sectors, materials is the one that has the most support, both in terms of valuation, but also cash flow and the potential for dividends. We expect that BHP and Rio will reinstate special dividends again this year. The amount of cash flow they're generating off current iron ore and copper prices in particular is excessive, and we think that'll find its way back to us as shareholders. Elsewhere is a combination, really. I mean, Korea is a market we've been adding to, and there's quite a few Korean positions. KV Financial is Korean, Macquarie, LG. So these are new positions, and I'll talk about a few of those in the slides ahead. So where are we positioned? Country-wise, China and Korea are pretty similar now in terms of weighting. And obviously the Korean weight's gone up more recently. We actually think Korea is the best value market, or certainly was the best value market in Asia. It's done incredibly well in the fourth quarter and into the beginning of this year. But there's some interesting companies there. The valuations are too cheap in our view, and we make the most of that by adding to Korea. The portfolio in China has changed a bit. We don't own many of the banks, and that's hurt us actually in the last 2 or 3 months. The banks have had a rally. As you've probably seen elsewhere, there's been a move in financials, and we came out of financials as a whole at the beginning of the year worried about interest rates and non-performing loans. And we really haven't captured that rally in banks in the end of last year. And we still remain fairly skeptical about how much growth there is in these franchises, despite the fact that they do have decent yields. So we've come out of Chinese banks. We prefer other financials. So we have, insurance in China and in both AIA and in Ping An. We have CITIC Securities, which also comes under our financial exposure. So we have diversified financials rather than banks. And the reason why we're so underweight against the broad index is because we don't have Alibaba and Tencent, which, as I say, are 11% of the index on their own. But there's others in there as well, like Baidu and JD.com. These are all big companies which we don't have exposure to. And the reason why we're not underweight the high yield index, which also doesn't have those stocks, is that they have about 10 or 12% of Chinese banks in that index. We currently have about 2%. So the differences between us and those two indices are really the lack of exposure to internet and e-commerce for the broad index and banks for the high yield index. Elsewhere, Australia, we don't particularly like the domestic market in Australia. We much prefer materials, and BHP and Rio are roughly a quarter of our Australian weight. In Taiwan, we've been reducing that position. We had decent weights in Taiwan Semiconductor, which we've been reducing, and then we were marginally underweight against the other indices. Hong Kong is a market we'd be adding to, as both in terms of the property sector, but AIA actually comes under Hong Kong. And more recently, we've been looking at a position in Swire Pacific, which is the holding company in charge of Cathay, on the prospects that we think travel will open up in North Asia in particular. And that's a fair point at the moment, that basically the portfolio is focused towards North Asia rather than South Asia. Generally, the economic strength has been in the north. ASEAN is still suffering, Thailand in particular, from the lack of tourism, but also Indonesia and the Philippines. They're still struggling to come to terms with the impact of COVID. Generally, North Asia has fared much better, and our portfolios at this point is still positioned towards that. Although I could see, as we go through this year, that changing somewhat, especially if we see places like Indonesia get to terms with COVID, and we start seeing, because the valuations there are pretty attractive relative to North Asia, which has done very well. Sector-wise, we're underweight banks, but overweight diversified financials. So insurance, as I say, brokers. We have investment banks, so we have Macquarie in Australia rather than, say, Westpac or Commonwealth Bank, which are commercial banks. Excuse me. Communication services, these are the sectors which haven't really done well for us, but make up the backbone of our yield, and which is telecoms in particular. Information technology, we have quite a high weighting for technology, but we prefer the enablers of technology rather than the branded platforms. So we're worried about regulation for Tencent, Alibaba, Baidu, JD.com, and some of the moves recently we've seen from the Chinese government around regulation and trying to reduce the power of some of these big internet platforms. We prefer the companies that provide that, so we have exposure to cloud services, to software, to semiconductors, which again enable the internet rather than being exposed to the regulatory or competitive element. Real estate's a market that hasn't worked for us. We expect that in a low interest rate environment, that real assets will do well. We've seen that in the UK with property prices moving higher. It hasn't happened yet in Asia, but we expect it will do. We're positive on materials, both the global materials like iron ore, copper, and we hold that through the Australian miners. But we also like domestic materials like cement, which we hold in China and in Taiwan. So as we come towards the end, just a little bit about the characteristics of the portfolio. As I said to you before, we have to worry about valuations, but Henderson Far East Income forward PE is on about 12 times earnings. against the market are coming pretty close to 17. Clearly, we have a high dividend yield and decent levels of dividend growth. I think what's also interesting here is that earnings per share growth is forecast to be almost mid-teens for Henderson Far East Income for this year, which I think is pretty attractive off that valuation point. The other point I'd make is the free cash flow yield. So our free cash flow yield is above our dividend yield, which should give you some comfort, again, that the companies we own are generating enough cash to pay us the dividends that we require. A quick comment on 4 companies which we've added recently, because I think the assumption is with Henderson Far East is that we only own high-yielding, boring companies that don't grow. That's not the case, and here's 4 companies that are anything but that. So China Yongda is an auto dealership. So as I said, the auto manufacturers have done incredibly well. All they have to do is mention that they're going to make an electric vehicle and the share price goes up a lot. But really, that's a massively competitive industry. And there's a lot of blue sky thinking at the moment, but ultimately it will get back to the fact it is a massively competitive industry and it's difficult to know who wins. But especially in China, we think volumes will be very supportive. So the number of cars sold will be very attractive. Plus the fact that you have services associated with that. So servicing and financing. So we think the auto dealers are well placed. And we prefer the people who are getting more money and upgrading. So Yongda specializes in BMW and Porsche. So it's really about people earning more money over time and upgrading. Aspirational purchases in the auto market. This is a company that trades on single-digit PEs, despite the fact that the auto dealers are now 25, so the auto manufacturers are anywhere between 20 and 50 times earnings, or in the case of Tesla, well, 500 times earnings. So we like that sector. Chinasoft, Chinasoft, the share price has been weak because it's been associated with Huawei, and Huawei is its biggest customer. But Huawei isn't going to disappear in our view, and it needs to reinvent itself. And in order to reinvent itself, it needs to spend more on research and development. So actually, the problems that Huawei has actually been positive for Chinasoft. And this is a software developer which trades at a pretty big discount to a lot of other peers. And we like this story. Again, a decent growth story. Thai Beverage is the largest brewer in Southeast Asia. It's focused on Thailand mainly, but also has a very significant operation in Vietnam. Again, this trades at quite a big discount because obviously Thailand in particular has suffered from the lack of tourism. And as a result, their beer volumes are down. But as that improves, we think that this is the brands that they own are very valuable, and the valuation will improve as the region opens up. LG is not really an earnings story. It's more of an asset story. It's the holding company for the LG group. So that includes LG Electronics, but also other things like LG Healthcare, LG Chemical, LG Display. And all these companies are actually doing quite well. They're in a sweet spot. LG Chemical makes batteries. It's got a tie-up with Tesla. The share price has gone well through the roof. And the discount that this company trades to its underlying parts went from an historical average around 45% to about 65%, which we think is too large. There's actually a decent dividend yield here because the discounts are so wide, in the region of 3 to 4%. And we expect this company to benefit from its subsidiaries doing well, but also from that discount to narrow over time. So in summary, probably I've gone on a little bit too long, but in summary, 2020 was a terrible year for us in terms of capital performance. Everything that could have gone wrong in terms of what the market was focusing on did go wrong. Yield wasn't in favor, value wasn't in favor, which are the two main parts of our process. But where we sit now is that dividend yield is incredibly cheap, and it's never been cheaper, or certainly not been cheaper in the last 20 years. And considering we have record low interest rates and people are getting older, and you get so little on bonds and cash, is that we think there'll be a move towards yield once we get rid of some of this shenanigans relating to some of these themes and fads, which I suspect will blow over, hopefully not too disastrously, but will blow over at some point. I think from a relative perspective, Asia looks well placed. The economy are recovering nicely. There's a few exceptions which we'd like to see COVID dealt with more successfully in places like India, Indonesia, and the Philippines in particular. But North Asia is kind of powering on, as we saw from China's fourth quarter GDP numbers, which were released the other day. 6.5% GDP growth in Q4 and over 2% GDP growth for the year. Obviously the best performing major economy globally. And we're seeing similar numbers. Taiwan will show GDP growth for last year, and Asian exports are all growing quite nicely. So Asia is returning to normal quicker than most, and as a result of that, I think we can have more confidence in some of the forecasts, both in terms of economic growth, but probably more importantly for us as bottom-up investors, more faith in some of the economic growth, more faith in the cash flow generation of the companies we own, and as a result, more faith in the dividends we receive. The caveat is valuations. Valuations are high everywhere, and they look optically high in Asia. But once you strip out some of these sectors which have really attracted far too much money and have got very expensive, actually a lot of value exists. And hopefully I gave you some example of that in some of the companies we're looking at here, which are still attractive growth companies, not in favor at the moment, but we think will be in the future. So I will leave it there. And thank you for watching this. And now normally I would open up the floor for questions, but clearly this is a recording, that's not going to be possible. But if you have any questions for either me about the presentation I've given, or for the management of the company and the portfolio, then please let me know. But also if you have any questions to the board about the report and accounts or anything to do with the AGM, then please can you contact the company secretary at the email address which is mentioned on this slide. Thank you again. Bye-bye.